On to 2025 we go, coming off another solid year in the S&P 500, but a new year brings new challenges. And traditionally, January is a decent month for the S&P 500 before we technically run into a bit of turbulence from a seasonality perspective during the month of February. As such, in today's video, we're going to be covering 5 of the best stocks to consider buying in the month of January. This list is going to include both growth stocks and dividend-paying stocks. So before we unveil this list, do me a huge favor, show your appreciation by simply clicking that like button down below. Subscribe to the channel, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And let me thank Vici for sponsoring today's video. When it comes to investing in stocks, research is key. But the problem comes with the fact that research can take so much time to copy and paste the data like you see in this video here. And to compound on that, investors are usually looking at hundreds of stocks just to find the perfect investment for their portfolio. And to eliminate all that, that's where Vici comes in, as it's a simple add-on to both Google Sheets as well as Microsoft Excel, and it's going to gather that data automatically for you. Whether it is getting all the data you want for a list of stocks like this, or whether it's building custom models like this where you can change the ticker and all the data will be downloaded for you and everything updates automatically. Or if you want to deep dive into financials of a company, Vici can do all that for you. Right now, for viewers of this channel, Vici is giving $15 off any of their subscriptions by using code MARK. You can check out the link down in the description below. All right, let's jump back into our video, taking a look at 5 of the top stocks to buy during the month of January. Beginning with stock number 1, which is going to be Salesforce, stock ticker CRM. Salesforce is another AI play. It's a software company, and AI is going to continue to be a theme entering 2025, where Salesforce is going to be able to not only push further growth, but also push further margin expansion. That's a combination I love to see. As you can see here, the company currently has a market cap of $327 billion, and over the past 12 months, shares are up nearly 30%. Analysts are also bullish on the stock in 2025 as they have a 12-month price target of $400, implying nearly 20% upside from current levels. In fact, highly touted technology analyst Dan Ives of Wedbush gives shares of Salesforce a price target of $425. I spoke earlier about the continued growth, but more importantly, the thing I'm keying in for this company is that margin expansion. This is a company that has seen operating margins expand from mid-single digits just a few years ago to 17% over the trailing 12 months. EBITDA margins the past 2 years were 15% and 19% respectively, but over the trailing 12 months, they generated EBITDA margins north of 25%. In terms of valuation, analysts are looking for the company to generate 2025 EPS of $11.22, which gives the company a forward PE multiple of 30.5 times, well below their 5-year average of 37.4 times. Looking from another angle, EV to EBITDA currently trades at 30.5, the lowest in the past decade plus for the company, and well below their 5-year average of 36.9. There's a lot to like when it comes to Salesforce in 2025. They continue to find unique partnerships to push that further growth moving forward. And that brings us to stock number 2, which is going to be Generac Holdings, stock ticker JNRC. For those of you unaware, Generac is one of the largest manufacturers across the globe when it comes to generators. And with energy needs changing and larger and bigger weather events happening, there's a big demand out there for power backups and generators. Generac share prices reached a high of near $200 per share back in November, but have since retreated back down to the 150s, falling 20% in a short period of time. The market cap currently sits at $9 billion, and over the past 12 months, shares are up 20%. And although shares are up 20% over the past 12 months, that includes a 20% decline we have seen just in the past month on really no major news. No earnings events, no corporate news that's coming out from Generac as a whole. It's just been selling pressures. And as a long-term investor, these are opportunities that we love to take. Analysts have a 12-month price target of nearly $180 per share, implying roughly 15% upside from current levels. During the pandemic, Generac saw record sales as more and more folks were forced to their homes and they were fleeing looking for backup power supplies, which included generators. Now with the pandemic behind us, we are back to normal operations for Generac, normal growth trends. And for that, you might think, well, financials are probably down from those record levels we saw just a few years ago. But when you look at free cash flow, bottom right of this chart, we are sitting at record levels with near record gross margin percentages as well. In terms of valuation, analysts are looking for the company to generate 2025 EPS of $8.29 next year, giving the company a forward PE multiple of 18.8 times, well below their 5-year average of 26.3 times. And their EV to EBITDA currently sits at 16.4, also showing that the stock is very undervalued, as their 5-year average is at 19.3 times. Generac is a stock that's been on my watch list for some time and now might be the perfect time heading into winter. And that leads us to stock number 3, which is going to be Vici Properties, stock ticker VICI. Vici is going to be the lone REIT on our list of 5 stocks looking here today. And for those of you unaware, Vici is the largest landlord on the Las Vegas Strip, owning properties such as the Caesars Palace, MGM Grand, Park MGM, the Mandalay Bay, and the list goes on. REITs in general have seen some selling pressure as rates are not intended to fall as fast as many of us originally intended. But from a long point of view, rates are still going to be coming down, and that's going to benefit this sector as a whole. So I'm looking for high quality REITs to add slowly to. This is exactly the position we were in late August before we saw our big run up. So now with a big sell-off in the likes of Vici, which is one of my favorite REITs and the largest REIT holding within my portfolio, I'm taking advantage of this drawback. Shares of Vici currently trade with a market cap of $31 billion, and over the past 12 months, shares are down nearly 10%. This is a fantastic REIT with a great management team and a portfolio of properties that can perform well really in any environment. Because you have to remember, Vici isn't the operator of these casinos. They have some of the best operators around, and Vici is one of the only REITs on the market today in the public markets that has continued to gain 100% rental payment. Even during the pandemic, the likes of Realty Income saw their payments drop down to 50%. That means if they were due $100 from all of their portfolio, they were only receiving 50% of that. Vici was receiving 100%. That speaks to the quality of the operators when it comes to Vici. And again, they're not looking for the operators to perform necessarily record levels. They just need them to perform well enough to be able to pay the rent. Analysts are high on the REIT, rating it a strong buy with a 12-month price target of nearly $35, implying more than 20% upside from current levels. In addition to that potential upside in the stock, as an investor, you're also claiming nearly a 6% annual dividend yield, getting the best of both worlds, and management has increased the dividend every year that they've been a public company. In terms of valuation, again, we're not going to be looking at price to earnings. Instead, we'll be looking at AFFO, where analysts are looking for the company to generate 2025 AFFO of $2.32 per share, which equates to a forward price to AFFO of 12.5 times, criminally cheap. This is well below their 5-year average of 16.3. And that leads us to stock number 4, which is going to be Qualcomm, stock ticker QCOM. When it comes to Qualcomm being a semiconductor company, they haven't really seen the upswing that many other semiconductor companies have seen. They've been kind of thrown out of the bathtub, if you will. And I think that's been a major mistake long term. And this is going to be an opportunity, especially for those of you that are value hunting. This is a company with a strong chip presence in handsets, which I believe could rebound in 2025 and into 2026. But this company is much more than handsets. They've continued to diversify into automotive, AI, Internet of Things, and so much more. The company currently has a market cap of $176 billion, and over the past 12 months, up nearly 9%. When looking at Qualcomm, a lot of the trouble has ensued when they acquired Nuvia, a deal that resulted in ARM bringing about a lawsuit that has held over the heads of both companies of late. If you've been following the case, it seems like Qualcomm has the upper hand, and this will release the buyers back into the stock when it's all settled. As a long-term investor, we want to be in the stock before this happens. Analysts are high in the stock, rating it a moderate buy with a 12-month price target of nearly $200 per share, implying more than 25% upside from current levels. In addition, Qualcomm has a long history of not only paying a dividend, but growing their dividend, as they are nearly a dividend aristocrat, increasing their dividend for more than 20 consecutive years. The company currently yields a dividend of more than 2%. In terms of valuation, analysts are looking for the company to generate 2025 EPS of $11.19 next year, which equates to a forward PE multiple of 14.1 times. This well below their 5-year average of 16.6 times. The stock has been consolidating now for some time, looking poised for a breakout higher. And that leads us to stock number 5, which is Advanced Micro Devices, stock ticker AMD. AMD is a company that I listed in my top growth stocks for 2025, which you can check out in the link down in the description below. This is the year for AMD. At least we hope. We're not looking for them to surpass Nvidia, but they are a clear second place winner, and the share price hasn't really shown that. This is the time where they need to close that gap, which will pay off huge for the share price and for investors. It's time for those acquisitions that they've been making to start paying off. The company currently has a market cap of roughly $200 billion, and over the past 12 months, shares are down roughly 15%. It's hard to think about a semiconductor company being negative over the past 12 months, but both Qualcomm and AMD have figured out a way to do that. However, with AMD launching a brand new chip and PCs looking to rebound in 2025, more of those AI-compatible PCs and laptops, this could be a great growth driver for AMD. Analysts are extremely high on the stock, rating it a buy with an average 12-month price target of nearly $185, implying nearly 50% upside from current levels. In terms of valuation, this is where things get wild. Analysts are looking for 2025 EPS of roughly $5 flat, which equates to a forward earnings multiple of 24.9 times. This is well below their 5-year average of 59.4, but for many of these high growth stocks, we don't want to focus as much on PE multiples. Instead, I like to look at PEG ratios. PEG ratios less than 1, showing that the PE that you're paying for and the growth that this company is expected to get, you're getting a great deal, which is the case with AMD. Looking from another angle, EV to EBITDA is currently at 43.8 times, which outside of the stock market crash in 2022, this is the cheapest that AMD shares have been in nearly a decade. And although I still like Nvidia for 2025, AMD is a major value play. And it just sounds weird saying that. So there we just looked at 5 top stocks to check out here in January, heading into the new year. Remember, seasonality, January tends to be an okay month. February is where we could hit some bumps, but we could still see some momentum moving forward into January. And these are 5 stocks I'm taking a close look at potentially buying. Down in the comments section below, let me know which of these 5 stocks would you be willing to buy heading into January. And if you haven't done so, please hit that like button by showing your appreciation. Subscribe to the channel, and we'll see you in the next one. Take care.